Welcome back to the Options Insider's exclusive coverage of the 2010 Options Industry Conference. Coming up next, we have a panel session entitled Innovation, the Options Market. The panel is moderated by Rich Repetto from Sandler O'Neill, and the panelists include Kevin Fisher from Interactive Brokers, Sam Leck from Leck Securities, Martin Mannion from Citadel, John Wirtz from Bank of America Merrill Lynch, and Jeff Woodring from UBS. Thanks again for downloading this session, and be sure to stay tuned to theoptionsinsider.com and Options Insider Radio for more exclusive coverage of the 2010 Options Industry Conference.
We're fortunate to have Rich Repetto join us today as the moderator for our panel on options market innovation. Many of you know Rich as one of the leading analysts covering our industry. Rich is a principal of Sandler O'Neill and Partners, and his research coverage includes the e-brokerage, execution venues, and e-specialty finance sectors. Rich's many awards and accolades are too numerous to mention here, but it should suffice to say that Rich is a true expert in this area, and we're delighted that he has agreed to moderate. Rich, the floor is yours.
Thanks, Boris. First, I appreciate everybody getting here so early on a Saturday morning. We think we got a great panel that comes from a diverse different backgrounds, and I will give you the introduction. First, to make sure I got this right, to my left is Kevin Fisher, 20 years in the options business overall. He's the head of block trading at Interactive Brokers, that very small market maker or broker and retail broker and market maker. Prior, he was a floor manager at Timber Hill for all the specialists in market maker, and he was actually a governor on the Philadelphia Board of Governors for 13 years. To his left is Sam Leck. He's the co-founder and chief executive officer of Leck Securities.
Known him for a long time.
Leck Securities Corporation, LSC. Leck executes and clears across asset classes, equities, options, and futures. They're known for their ROX, PC-based algorithmic trading system. So we have a sort of an automated algorithmic trader represented on the panel here as well. He also has just 20,000 clearing accounts that they clear for as well, and has experience at Bear Stearns and Chase as well. Third good friend of mine, Marty Mannion, is the COO of Citadel Execution Services. CES is part of Ken Griffin's Citadel Securities. If you don't know it, besides Ken Griffin running a major hedge fund, he also has a major broker-dealer that's very dominant in both the equity and option space. CES is one of the largest market makers, as with Timber Hill. And prior to joining Citadel 6 years ago, he spent 4 years working at the NASDAQ in the Transaction Services Group. To Marty's left is, let me get this, see if we didn't move around here a bit, John Wirtz. We did move. To Marty's left is Jeff Woodring of UBS. He's been with UBS since 2004. He's involved in the order flow, routing, as well as the market-making operations at UBS. Jeff brings, truly global experience. He's traded derivatives in Hong Kong, in the Asian markets, as well as Europe, as well as experiences now at UBS. And he's been with UBS since 2004. And last but not least, to the far left is John Wirtz. He's a managing director at B of A Merrill. He's head of the broker-dealer execution group, as well as the global head of electronic futures. Previously, John was the VP of derivative products and headed the options business at the NYSE. He was also at the Pacific Exchange. John is on the board of the CBOE, so I know that has to be a very calm experience as you go through the demutualization process at the CBOE. So with that, our panel here is we're going to talk about the options industry and innovation. There's a lot of things going on. I think it's unique that we have different segments of the industry represented, a market maker, a block trader, from the bulge bracket execution services to an algorithmic trader, et cetera. So the first thing I wanted to, and we do want to make this interactive at the end, so hopefully you'll have some questions as well. But first topic we wanted is, and I understand it, and I'm surprised that it hasn't been more debated here at the conference. I understand it wasn't. But it is about the pricing in the options industry right now, pricing at the exchanges. There's been a number of price changes. There's a new hybrid model at PHLX with pricing. It has caused market share shifts. And I guess I started off with Marty as being the market maker, and a market maker on a number of exchanges. But how is that impacting you? What are you seeing? What are the most significant changes, to your business from all these changes that are going on at the exchange level in pricing?
Certainly. I think one of the things I'm responsible for at Citadel is co-managing our routing business for retail broker-dealers. And one of the biggest changes that we've seen as a result of the pricing changes is certainly a requirement for much more sophistication in order routing. If we look back at our business even just a year or two ago, you had fairly similar pricing models across the exchanges, fairly similar market structure models as well, and so your routing was much more static. You had a table, you routed to a place where it had to be on the MBBO, obviously, but you also felt like you had an optimal opportunity to interact with the order from a market-making standpoint, and where the costs made sense. With some of the pricing changes we've seen, in particular, just over the last 3 or 4 months, it's really forced much more sophistication into the router. And it looks, very similar to what we see in the equity markets, where with spreads a little bit tighter, maybe less liquidity at any price point on the MBBO, there's really a requirement to, for a retail order, sweep liquidity across the marketplace, and you have to constantly adjust your routing technology or your routing rules to take into account pricing changes, as we've seen, as Rich mentioned, on the PHLX and certainly on the ISE and across the other exchanges as well. So that's one of the places I think where we've seen, or we've been spending a vast majority of our time, Rich, is on smart routing and figuring out both, there's obviously the market-making side where the pricing can absolutely influence the types of markets you can make, but on the retail side, when you talk about routing, it really is critical that you're getting the order, you obviously routing to the MBBO, but you're getting it to a place where the cost makes sense for a retail broker.
Yeah, I do want to get into this. So the pricing, this is about innovation. So the exchanges are changing the pricing, and they're doing things to attract liquidity. So I guess maybe I take, from Jeff's standpoint, is this the best way to attract liquidity? Is it real innovation, or and how does it impact you as you make your decisions on routing at UBS?
Right. I guess I would look at it, take a step back. If it's innovation on the options side, what's changed in the last 10 to 15 years that has been the reason for the explosive growth in the options business. And I think a couple of key things have happened. One, when we got rid of the single list products and allowed them to be listed across all exchanges, it became a much lower cost platform for the end user. Thus, they consumed a lot more of it. And ask anybody that was in that business when it was a single list how much money was being generated on our side, and they yearn for those days again. So that brought the cost down for the end user. We saw a lot more volume. The second piece, I think, that changed the landscape was bringing the IC to the marketplace, allowing an electronic platform for ease of barriers of entry, let's say, but also the pro rata system put a huge amount of volume on the bid and the ask for all the markets to take advantage of, and not necessarily having to go down to a floor and quote to get that size. So those are two things I think caused a big uptick for us. And for right now, it seems as the exchanges and entities are really focusing on how to tweak the pricing model, be it maker taker or pennies or what have you, to extract a little bit more, a couple points more market share in the short term. And I think it's providing a little bit of a distraction for the end users because it's not so clear on how much things cost to trade. I know on our side, it's costing us a fair amount of time and money to keep up with the weekly changes that are coming out.
Do you change your routing algorithms or based on the pricing?
Without a doubt, because there's a certain low cost that you're charging, a retail customer to transact through your pipes, and if you're not in tune with the changing rates, you're operating at a loss quickly if you're not keeping up with these changes. So it's been an ongoing battle for sure.
And I guess the question with all these, I've heard complaints as we've prepared for this panel that people spend an exorbitant amount of time trying to stay current with the pricing, and I guess the question would be, to John, is this pricing model the maker taker? And certainly we could discuss the SEC's intervention here with caps on fees, but are the pricing models and the innovation that the exchanges are so-called bringing, is it sustainable? And what do you think as a major bulge bracket, and what do your customers think?
Well, we're used to the pricing changes in the equity world every month, and now we're starting to be subjected to that in the options world. So I don't see that going away. It does take a tremendous amount of time, and it's frankly a big pain in the neck. But we have to turn around and educate our clients consistently and constantly about all the various pricing changes. Obviously, what you're seeing is there's 8 exchanges. It's very hard to differentiate between them. Pricing is one of those components. Pricing in and of itself is not innovation, but if you combine it with some functionality and some unique market structure, you have something there. But we're not really seeing that. What we're seeing is pricing changes to try to win some market share. Now, the upside for us, besides all the effort involved, is exchange fees will ultimately come down. We're starting to see a real pricing war in the options industries as exchanges try to battle for market share. 8 exchanges may not be sustainable, or maybe they'll be subjected to reduced market share. But at the end of all of this, it should be lower exchange fees for all of us because they're going to keep beating the heck out of each other to win market share.
And we're at 8 exchanges, and there may be even more behind that as well. And I guess I think you bring up a great, with all these pricing changes, the maker-taker model, it appears that the option industry may be evolving a lot like the equity markets. And algorithmic traders played a big role in the development and the efficiencies in the equities market. And I guess, Sam, from an algorithmic standpoint, an algorithmic trading standpoint, how do you view the pricing changes? I know you've dedicated resources to try to stay up with it, but are the exchanges doing right in innovating in the pricing to develop your type of customer and your type of, the automated customer, and is it beneficial for the industry?
Well, we pass, Rich, all these fees on to our customers, and recently the only thing I've heard are complaints. It's kind of you go online and you want to buy a TV and you've priced everything, and I select the cheapest TV, and I'm just ready to check out, and I find out, wow, it's $1,000 shipping, right? And this is what this pricing is all about. And it is pretty deplorable when we're talking about innovation in the options market that the first topic we're talking about is innovative pricing structures rather than new products that could be brought to the marketplace. There's a great opportunity here right now, Rich, and we shouldn't miss it. Right? Congress is debating forcing a whole slew of products onto the exchanges, and rather than trying to squeeze an extra penny out of the end user, which the exchanges are trying to do, right, we should be focusing on expanding the marketplace and leaving pricing as it is and more transparent for the end user. It has become absolutely ridiculously complex. It is to no one's advantage other than to make it more complicated so the end user doesn't understand it. And all of this has only one goal, and that is to try and steal order flow from someone else while collecting more from the public. This is all very bad, and I'm against it. I think the pricing structure should be simple, it should be transparent, and as you have commented, some of the speakers have commented before, with more exchanges and more competition, one would expect the pricing to go down. As a practical matter, all I've seen is it going up, and the only way you can accomplish that is by confusing the consumer. And the exchanges have been very innovative in doing it, and I think it's a scandal. I think there should be an end to it. I think pricing should be transparent and clear to all. There's a great opportunity right now, as I started to mention before, and all I've seen from the representatives of the various exchanges Well, I guess we're going to wait and see whether we're going to be able to expand what should be expand our line of products by maybe tenfold, but we're not really interested in it. Let's spend all our time on innovative pricing. It is an opportunity that we could lose, an opportunity we have not seen as long as I've been in the market, and it's really a terrible shame that the options exchanges are not working day and night to try and bring these new products onto our floors and into our marketplace. That's my take on it.
Please hold your applause. Does everybody
Keep
on
the tomatoes too.
Does everybody on the panel agree with Sam's?
Of course not.
No, I mean, I can only speak for my firm, but, as some of the other panelists have said, this is a huge expense now to a trading firm, both buy and sell side. The most valuable asset at a lot of our firms are programmers, and we're spending an inordinate amount of programming time looking at fee changes, sometimes 2-3 times a week from the different exchanges. And we used to just simply make the change because, as Jeff pointed out, it's too expensive not to make the change and be sending your flow to the wrong spot. You want to get your customer the best price, but if it costs the firm and you're not passing on the fee, that's a significant cost to your bottom line. Well, now we've taken it to the next step where we found that we were making changes too often. And so now if we know for sure, Exchange X brings out a new fee schedule, and it's going to cost us a penny more to go there, so we make a programming change, but then we find 10 days later that the regulators say you can't affect that fee change, and we have to undo the programming that we just did. We now have to have programmers actually develop ways to anticipate the probabilities of the new exchange fees actually taking place and staying in force for a period of time, that it makes sense to do the programming. Also, is the new exchange fee enough of a fee to warrant the programming time? I mean, it's an extremely complex environment that is costing us a lot of money, and at the end of the day, we're going to have to start passing that cost on to our customer if we aren't already. And as Sam pointed out, I think that in the last 10 years, we've seen an enormous explosion in option volume, primarily because we've enabled retail and institutional and smaller institutions to have access to the options marketplace at a much lower cost. And if we can put buyer and seller together with a lot less price friction, they trade more, and that's good for everybody in this room. And we seem to be taking a little bit of a backward step, that we're raising costs, we're denying cheap access to the marketplace. And in addition to exchange fees, there's a lot of questionable regulatory fees out there. Exchange One puts out some regulatory fee because there are our regulatory authority, and then the other 6 exchanges said, well, they got away with it, I might as well put it in there too and see if it sticks. I think that we're moving the wrong way. We've had incredible growth in the last 10 years. Arguably, we've reached all of the low-hanging fruit, at least in this country, to trade U.S. derivative products. If we go and we want to expand our efforts to bring Europeans and Asia to trading U.S. product, we need to make sure that they have a low-cost access to our markets to get the next level of expansion.
So, I think we've sort of talked
that more.
Yeah.
What I think is being pointed out here by Kevin is not only do you just change the rates, that used to be easy. You could go into some table and change something. Now we've got all these complicated methodologies. Different type of people get charged at different types of rates. This whole new invention of the professional. In general, in my comments to SEC, I've always said any type of discriminatory pricing is wrong, and it's completely inefficient. And Kevin did bring out a very, very good point. These regulatory fees that one exchange charges a member for executions not only done on its own exchange, but done on a different exchange, right, are completely out of line, as is the increase of some very questionable regulatory inquiries where people want information for the sake of having information that also adds to the cost. Not to be forgotten. Not just the fees, but then also all the time it takes to pay for the make work that some of these regulators make. And that's really all it is make work. So I agree with Kevin. We're going completely in the wrong direction when it comes to fees and regulatory oversight on the exchanges. It's time to change direction. It's not too late, but we do have to do it.
Now, I do at some point want to go to this directional change that you're talking about, possibly new products, OTC products. But I do want to give you a little pushback on a little bit of the argument. There's no doubt, I think most people, you got applause, Sam, that probably the complexity of the pricing. And I think we haven't probably, at least in my mind, just explained very simply in a very simple case, one of the issues of a high rebate attracting a posted order and then by the high rebate, allowing the market make it a slightly better price, which requires someone to come in and take that quote, but you're paying a higher fee, and that was your equivalent of the higher,
higher shipping costs.
Costs, which was a great analogy. But to push back before we move on here, if you look at the equities market structure, initially, there were some firms that went inverted pricing. But it ultimately took a few iterations of the pricing structure to get the efficiencies out of the. It took a while for the spreads to narrow, but the equities, for the most part, right now in the U.S. is looked at one of the most efficient markets in the world as far as tightening of spreads, best execution, best prices. We have seen spreads tighten in options, as Interactive Brokers has experienced. So, could this be just again, and help appears to be on the way with the SEC and caps on fees that should control some. But is this part of the growing pains as you get to a more efficient market?
Well, eventually competition always wins, right? But the problem is lack of transparency here. And the solution is not for the SEC to get involved in something that is nothing less than price regulation, right? We are Americans. The American way is to believe that competition works. All the SEC should be doing is enforcing transparency so people understand what the fees is, and then the rates will come down. Competition will do its thing. Right? I'm a person that believes, as many of you do, because we're in the marketplace, we believe in the workings of the free market, and so long as these fees are transparent and understandable by all, we will see lower fees and tighter spreads and be able to expand our business. But right now, as I've said a couple of times, and I'm going to keep on saying it, we're going the wrong way by making it more complicated so nobody understands it anymore. Right? And once again, it's deplorable on a panel for innovation that the first thing we're talking about is innovative pricing. Why aren't we talking about new products? I know we're going to talk about it later, but that sounds like what should be the absolute most important thing. Right? So, I'm against it. The fee should be simple. The SEC should push back when an exchange wants to come up with some complicated pricing structure, discriminating between users, making it unclear. Sometimes they can't even tell you on the report, right, what they're going to charge you. They can only tell you at the end of the day or at the end of the month or whenever they figured it out. Makes it almost impossible to pass these expenses on to your customers. So what is a firm typically going to do? They're going to take a conservative approach, and oftentimes the customers get charged too much. It's just a terrible idea what's going on right now. And it's much worse than the equity market used to be, and certainly much worse than the equity market is today. And as you pointed out, if we want to attract more business, we need more transparency. And it's very easy to say we have the biggest and the largest and the most liquid markets in the whole world. Well, I'd go take a look at some of our competitors overseas. They're pretty large and they're pretty liquid, and we cannot take for granted that we're always going to be number one. As a matter of fact, options as a percentage of total trading in the United States is less than it is in Europe. So in that regard, we're already behind. And there's a lot to lose, and we cannot take for granted that we're going to be number one all the time.
I would just add to that point, I think that you've had a market structure in options that for a long time has you have a huge retail presence, you have a huge traditional market making presence. One of the things Sam's talking about is you have more perhaps professional or different types of market participants that have come in and traded options more actively. I think the exchanges to some extent you've got 8 exchanges, as we talked about earlier, each catering to perhaps a slightly different client base. I think that over time you will see some congealing of the pricing models, but I think as frustrating as it is for market practitioners to deal with the pricing changes, at this point in time it's somewhat inevitable, at least in the short term. And I think if an exchange is not doing the right thing on price, it will lose market share as a result. I think you also see, to some extent, across the product spectrum, you see some real differences in how certain products trade, and maybe that's somewhat of a new phenomenon. You have, with penny quoting, you have products like a Citigroup or Spiders or a Q's that trade very differently than a lot of the other products in the marketplace. And so maybe they trade more like an equity product, and they account, in this particular environment that we're living through, they account for a very significant part of the overall market activity. So I think that's where you're seeing a lot of the variation is across the product spectrum. Has our historic pricing been right? If we've lost share, how do we respond to that? And can we come up with some new kind of a model that works for what our historic or traditional customer base has been on that particular exchange? So
I hope I know there's a few of the exchange leaders still here, so I hope they're listening to some of the feedback you're giving here.
I really hope they are listening.
Okay.
On the change topic,
Exactly.
with change is always somewhere in there an opportunity. And I think some of the frustrations is that the focus on fees is becoming a way in which there's some market models now that are looking to merely transact to collect the rebate and not necessarily be there to provide liquidity. They're there to trade an 8-cent option in Microsoft because they're going to get paid 35 cents or a quarter to be on that bid. It's just an interesting dynamic that's become the focus, less so than having the best prices or looking for the greatest vol, et cetera.
So let me put out the question then. What do you all see as true innovation then? What besides, I still think pricing, and it was a topic that we all sort of had talked about, but you make a good point, Sam. So what types of innovations do you see where there's big opportunities for the industry? I know Jeff has mentioned a little bit about standardization, or what does anybody think as things that away from the pricing, and I still think there's a little bit more debate on the pricing to go, but go ahead.
It's a topic. We're talking about overseas opportunities and how the marketplaces are there. Coming back to the U.S. after being in the international market, it was very interesting to note that there's nuances to, especially the single stock world, where let's take expirations. There's this setup of January, February, March cycles, and it's relatively confusing to understand which symbols reside in which expiration cycle. And for back in the day on the whole side, we were doing a lot of dispersion, and you can't really do it if single stocks don't all have the same months versus the index. So that's definitely something I'm trying to get voices, or my voice to be heard as far as standardizing what's offered. Because I know it's pretty confusing from the customer side that they look at a symbol and they want to trade for an upcoming catalyst, and they said, okay, fine, it's 4 months away, and they go to look for that term, and it's not there because it's on the February cycle and not the March cycle. So I think that's something where it's be pretty easy to get buy-in. It might be harder to execute. It might need to go to like the OCC level to sort of push that out. But that's something I think is around the corner. And then the nuances of the available strikes is another one of my pet peeves, where some have 10, some have 5, that random $2.50 increment that's allowed at some price point and not others. And then this whole random dollar available strikes by SRO. And it just seems like it's a relatively confusing platform that isn't too transparent to the end user and is causing a little bit of confusion as far as what's available. So that part sort of narrows it down for me, is like I think we need to standardize and make it more transparent for people to understand what's available, and then we can grow volume, at the top line, and then let the exchanges fight for a larger pie or a piece of that pie. So it's something I've been trying to get someone to listen to.
Rich, I would just say that as we talk about innovation, to me, the whole point of innovation is to increase the volumes on the exchanges and for all of our firms. And we have to find a way, what is the value add that we can do that? And education is probably a huge part of the innovation, that there are still so many clients out there that have never traded an option or have never traded a U.S. option, or they do it in very small size. I mean, how many long-short equity hedge funds out there that don't trade options, and why? We need to be getting to these guys. It's let's increase the whole pie. We don't have to keep splitting up the pie in smaller and smaller slices. There can be a bigger pie for us to share, and education, I think, is a huge way to innovate and bring new customers to our business. From my seat, I deal with a lot of guys that have a lot of money, but they're really not what we think of as traditional option traders. They're not. They didn't make their living. They didn't make their money in the options business. They've typically made it doing something else, and they're just starting to trade options, and they have
where they come to lose it.
Yeah, this is where they come to make a small fortune. If they start with a large one, and they need to be educated, because it's my job to a large degree to keep them in business, and save them from themselves. And we see a lot of guys that'll come in with a lot of money and they're gone in 3 months, and that's not good for anybody. So they need to understand. They need to understand the basics of risk management, I think, more than anything. But they need to also understand, guys that aren't using the product, why aren't they using it? How can we go out, and options are a very scary thing, for a lot of people. They think that it's gamed and that there's no way that they can win it, and we need to convince them, to show them how they can add to their basic returns without taking on undue risk. And that's order flow that we can all really use. So the more that we can do to find potential participants that are not using our products and educate them as how to use the product, the better for the industry. We all grow that way.
And John, you've intimated B of A Merrill is doing some unique things on training and education. What do you see the clients are looking for in regards to that will take them to become deeper penetrated in options?
Obviously, we're a very different firm than most of the firms up here. We have 20,000 financial advisors, many of which are active in options. So there is a whole educational team internally that works with the FAs to help train them, and will also go out in the field and sit down with those clients per se. We participate with the industry events as well, and the OIC and so forth. And on the professional side, we have an execution consultant team, which will go out and sit down with firms and talk to them about market structure and general themes and that's happening in the options world today. So we'll fly them all around and sit down and meet with these various groups. But I do think, as much as I love to beat up exchanges, particularly when they're hosting me and feeding me here, it is difficult for exchanges to innovate. It's a tremendous amount of money. I mean, for every SPX and VIX products, there's literally dozens and dozens that have launched and failed and you've never heard of. If you look at the equity world, no one can probably tell me the last time something truly innovative has ever happened there. So it's probably going to end up being much more on the firm level, pushing around the edges and innovating new products there, and the industry level, which Sam was referring to, about pushing more products to the listed space off of the over-the-counter world. But for public companies like NYSE and now OIC to spend millions of dollars on products which may or may not ever return a nickel, it is difficult returns. And remember that the VIX will launch for years and years before it ever got any traction. So it's a tremendous investment, not always a good one, and particularly for a public company, it's difficult.
I mean, I think you make a great point there. If you don't, I guess I have the privilege of following other industries like the futures industry, which they have what they call non-fungibility, where the argument to keep their non-fungibility is that they pay for their investment into new products, that they spend so much money developing a product. Why should it be able to be traded across a number of industries? Here, the SEC is mandate, or you have a fungible central clearer, so I do think that likely plays a role. Now, but there is, you mentioned OTC, that does appear like there's a big opportunity out here, whether it's right in the options space or certainly in clearing, and I follow this as closely as anybody on how the Senate reform and the derivatives bill. But what do you see, Sam, when you talked about where we should be going, other opportunities? Is it OTC or is it?
Well, it's a historic event that Congress is almost forcing products into our laps, and we certainly should take advantage of it. And I'm just shocked, quite honestly. I understand it's expensive to launch a product, but I don't think we're going to get this opportunity again anytime soon. And if we don't take it, we'll just keep clunking along and we might do okay. But this may be an opportunity to, say, not increase our volume by 10, 20%. It may be the opportunity to increase it tenfold. And these things come along maybe once in a lifetime, and you don't strike, or at least try to strike when the iron is hot, right? You're gonna regret it. Now, the fact that it's so incredibly expensive to launch a new product is also something we should be looking into. When you have an industry where innovation is being held back by startup costs, then typically what economists will say is that industry might be overregulated. Classic example is if you want to start a business in Argentina, it can take you 6 months to get all the necessary licenses, as opposed to the United States where you don't need a license at all. It seems to me that with all the regulation going on and the make-work and paperwork that this creates, it is becoming increasingly expensive to get new businesses off the ground. And it's a general concern that the country may be losing its competitiveness by too much regulation. I would also like to take this opportunity to say that it shocks me that there seems to be a complete consensus that if there had been more regulation, the financial crisis wouldn't have happened. I think it's an absolutely idiotic thing to take as an absolute given that that's the case. But that's where everyone seems to believe. We need more regulation. That's going to make our markets better. I'm not a believer in that. I think we have too much of this already. And it's hurting innovation and it's hurting profitability, and eventually the business is just going to go somewhere else if we're not more competitive.
I think Bill Brodsky did a good job describing yesterday one of the ways that they're perhaps hamstrung with SEC and CFTC approval of certain products. It can be difficult at times to get a product listed on an ETF that trades on a stock exchange, and so it can take months for that process to get pushed through the regulators. So that's clearly a problem. And it's something that I think people are pushing for, and where there needs to be improvement, and where there is perhaps a significant over-regulation when you're trying to bring up a new product to an exchange space where things can trade so efficiently. I think following up on the point that John made earlier, there is to some extent, it's difficult for the exchanges to perhaps foresee some of the innovative things happening in the marketplace, and that's where, from our perspective, we do see some of the push from the end users and our clients. For example, we've seen a tremendous amount of growth and push on the brokerage side or the retail side for complex products. Two-legged, three-legged, four-legged products, equity tied to option, products. And so what we've now seen the exchanges do over the last 2 or 3 years is significantly improve the platform for trading spread products or complex products by making them electronic, by making them more efficient, by offering price protection on legs across the MBBO of various exchanges. So I think that's a place where you've seen the retail brokerage community, whether it's Ameritrade, Thinkorswim, Fidelity, really pushing innovation, pushing that as a new product set, and then you see the exchanges adapting to that and creating a marketplace or a market structure that's efficient that allows for that type of activity to increase. From an end user perspective, one of the most damaging things is when you don't get the price you see on the screen, or you trade something significantly away from the current market or from the true value of that product. So that's where the exchanges, I think, help in the innovation process of creating the fair platform that allows end users to push product into the exchange.
Yeah, on the OTC topic, to put out a sort of a generic topic, I think the exchanges could focus on is that we've seen massive success, albeit with the VIX. The beginning of it was kind of an issue with the perceived manipulation of the print, but persevering through that, it was the success, I think, is because it replicates the variance swap, sort of dynamics on the OTC level. So if we can, explore why are the end users trading in the OTC environment versus going to the listed world and go from there. I applaud the changes that went through on the Flex product and given more abilities to have different strikes or terms, what have you, really helped my end users go from the OTC world where they have counterparty risk that cost everybody lots and lots of money in 08 and 09 to now be able to route that stuff through the exchange level and take out the counterparty risk. That was a big change that we have actually marketed to our guys as far as services. So I think that's an area where, go solicit the people that are using the OTC product and say, well, why use an OTC versus listed, and focus on it from there. And that might be a way to sort of change the dynamics of what we're offering versus coming up with a new and the next VIX kind of thing.
I think we should be looking at ourselves not just as options exchanges, but as derivative markets, and expand our horizon, right? I think there's some, and I'm just going to keep on saying it until somebody hopefully does something about it, but I'm really looking for new products, complete new things, and we have this opportunity, and sure, a lot of them are not going to succeed. And there are going to be a lot of people trying to make it not succeed. There are lots of reasons why a lot of products do not trade on an exchange, even though they could trade on an exchange, and that's simply because people don't want to trade them on an exchange. We have the opportunity that Congress may force that to happen now. And just once again, if we lie back and just wait and see what happens, it's not going to come our way. Somebody else is going to take this. So, we could talk about, adding a strike here or there or an expiration month or changing this a little bit. There's a much, much, much more opportunity out there to be done. And I'm looking forward to it because I just want to make a lot more money. And I think we can if we have a lot more product to trade. It's time for something new. And out of crisis come great opportunities. And we just need to take them. And I'd like to get everybody motivated to really start working on it. But I got to tell you, somebody sat up and told me, who works for me, here's a business opportunity maybe we should think about getting involved in, and we'll see how it works. And, you've got to make it happen. It's not going to happen by itself. You've got to make it happen, right? We've got to be a lot more proactive. We've got to work a lot harder to get this thing done. And it can be done, and it's going to make us all a lot of money. We're going to do really well, but we got to work at it. Right? And that goes for absolutely everybody here, and primarily the exchanges that are in the best position to benefit not only themselves but the whole industry from expanding the horizon to complete derivative marketplaces. And once again, now is the time to do this.
And again, I still think that a lot of our growth comes from offshore. I think from Europe, for example, my firm's seeing more than 50% of the growth coming from outside the U.S. And there are some significant products that trade overseas that we already know are successful. You've got Kospi, and you've got Eurex, and you've got stuff on the DTB. And speaking to your fungibility issue, things seem to trade more when they're listed on multiple exchanges. Maybe we need to make some relationships with the overseas exchanges and get those products over here.
It's because we're always assuming that we're number one. And go take a look overseas, right, as you guys have. I mean, there's tremendous trading going on over there, and we can't assume that we're going to be number one all the time.
Yeah, and some cultures want to trade more than this culture does. Right. And, let's give them the opportunity. They tend to want to trade their own products in their own country, but if we can bring those products here and trade it on our time zone, there may be huge opportunity there.
When we prepared for this panel, there was a comment that said, and don't want to downplay the exchanges, but there hasn't been true innovation, with the exceptions of automation of the exchanges, with the exception of new products like the CBOEs, VIX-related products, and things. And innovation maybe around expanding education-wise. I guess my question is, and your comments have been sort of focused on this big opportunities in front of us now. And there's no question, as a guy that follows, again, the futures industry as well as the equity industry, those industries are changing because of regulation, because there's an opportunity to change, because these products were not going to move if everything stayed status quo. For example, interest rate swaps. The big opportunity right now appears that they'll be cleared and possibly traded, not at the dealer, but cleared on exchange and possibly traded on exchange, or at least what they call a swap execution facility. So I guess my question, my long-winded question, is to say, should the regulators be helping, or should the exchanges be prodding the regulators, or should the regulators just in general be giving the option industry more opportunities to get more involved? And I keep hearing, I think it's the OTC opportunity that you're talking about, new opportunities that are outside the bounds of what you're doing today. Is that?
Yeah, absolutely. But you can't look for the regulators to help you, right? The regulators are there really to hurt you. I've never seen anything positive come from the regulators where they actually push you in the direction of creating.
Well, they're going to help the futures industry. Right?
Well, I mean, maybe they're going. Maybe this is the one exception, but I don't think this is the case that we can lie back and say the regulators are going to make my day for us, and they're going to push all this business our way, right? What they're going to probably do is hurt the over-the-counter dealers without helping anybody else. Like I'm not very. I don't look at regulation as a source of innovation, right? There may be some innovative theories that the regulators come up with to waste time and money, but
some of the changes that are being proposed, I mean, definitely are pushing towards that OTC environment. And I know, I would guess that most bulge bracket firms want to sort of protect that setup because there's a lot more barriers and there's a lot less transparency as far as how those prices trade. So,
right.
In our business, we're looking to push risk to those that want it, to those that don't, at a fair price, so that people can transact and make a little bit of edge. In the OTC market, understand there's going to be some barriers there and resistance to wanting that to go to a listed market because, now you have to deal with letting the whole marketplace see that trade, potentially participate with it at a lower level. So I can see the regulators actually forcing the hands of some of the firms that don't want to have the OTC business go to the listed market. So it might actually
that's why it's a once-in-a-lifetime opportunity
to sort of push that along. I would agree.
Well, and another regulatory change that's recently happened is portfolio margining. And that's given us a huge opportunity to increase the trading volume of relatively small capitalized firms. Instead of just Reg T, they now have the opportunity to go to portfolio margining and take 8-10 times the positions. We don't want them to overtrade, but again, I get back to my earlier point that I think education, especially along the lines of risk management, is going to be hugely important. But something as simple as a change in margin rates will really help expand the industry. And we keep speaking about futures. Look at the difference between futures margin and the margin that our customers have to pay. It's enormous.
Yeah, but put this in the light that we're the only country where this is regulated anyway, right? So you can say, and I agree with you, by the way, that portfolio margin is a vast improvement, but there's a real question why the regulator should be involved in this period. I mean, it's made trading for many years not. Reg T margins on options are ridiculous, and it's constrained trading for many years. So, yeah, it's a good idea that they finally allowed portfolio margin, but it's still not perfect, and it's still a big question to me why this should be a subject of regulation to begin with.
Well, I think regulation is important in a sense that, again, people want to know that it's not gamed, that they have a chance of winning. And they need to know that someone's looking out for their interests.
Oh, absolutely. But I don't know if margin is generally an unwelcome protection for the client. Right now, I'm not saying we should necessarily get rid of it, but it's being regulated in too much minutia. I definitely prefer the British system to the American system when it comes to securities finance. It's just every little detail, the regulator is going to tell you how you ought to margin it. I mean, it's not a good idea. We're going to be back to my example of starting a business in Argentina, right? It's almost impossible. The barriers to entry are enormous. The cost of compliance is enormous. And at the end of the day, it's hurting our competitiveness.
I want to, before I go out for questions, I want to recap a little bit. I think we started talking about pricing, and the debate was whether this was real innovation or not. Obviously, some felt like it wasn't innovation at all, and that it shouldn't even be on the agenda.
Exactly.
but
it's innovative. The things they come up with are very innovative, but it's not innovation.
Yeah, and I would say at least some of the pushback is that might be a stepping stone into overall more efficient markets in the long process of getting to more efficient markets. But that's a debate that we can continue afterwards. I think we talked about that maybe the industry and the exchanges are, and actually at the firm level too. I don't think anything can be left out. Maybe there's opportunities that we should look beyond just the pure option industry, maybe OTC opportunities. Look, for lack of a better word, out of the box.
Right.
Third, I think we talked about education. We didn't get quite into it as deeply, but people are, after spending a fair amount of time with each of the five here, firms are doing things with education. They're also doing things with technology, giving tools to that just making significant improvements in giving people the ability to understand and to get the technology access and abilities to trade. And we did not get into that, unfortunately. Certainly, I think that's the general overview. We didn't get into specifics on OTC opportunities because I think that's really a problem because there isn't any specific products right now. And we talked about the debate on whether regulation plays a role in innovation here or not. Anyway, so with that, we got 10 minutes. I just wanted to open up and see if anybody in the audience could probe and get more innovation from the panel. Put it that way.
For all this discussion about pricing complexities, the one topic I don't think I heard any of you mention was penny pricing. The introduction, continued expansion of penny pricing, in your opinion, was this a key driver that drove us to this point where everyone up and down the food chain has to scramble to try to maintain their profitability? And if so, was it a mistake in order for that to be introduced?
That was definitely not a mistake. I mean, it provided a lot of different dynamics. Obviously, the retail customer pays a lot less cost in crossing bid-ask, and I think that's made the growth actually increase as far as looking at somebody wanting to trade for a certain catalyst, let's say earnings coming up. If they're looking at a 10-cent wide market and they're going to have to cross that both in and out, they're probably going to be less or more reluctant to put that trade on versus if it's Microsoft and it's a penny wide. They're looking at their costs beyond commissions being relatively small. They're going to do that trade. I mean, we're seeing more and more people look to transact on the options side because the spreads are tighter, even though, there's less liquidity there. But on the counter argument of, all right, there's less liquidity, like the traditional cash market saying, well, there's not a lot of block liquidity out there. I would say it's actually better for my business in the facilitation world because it's not sitting there. Microsoft isn't 10,000 up, a dime wide. It's 3 cents wide, Timber Hill on both sides, 4 up, and somebody that wants to trade 5,000 contracts. Somebody wants to trade 5,000 contracts, they need to find someone that's going to stand there and show them liquidity, outside those bounds. So if anything, I've sort of embraced it because we have to. It's somewhat inevitable that we're going to roll down that line with all symbols, but it's not necessarily a negative in my view.
I think it has definitely been I think the pricing changes, though, have been a byproduct of obviously of the move to pennies. It's for some of the maybe traditional players, it's certainly made the business a bit more difficult, and you have to retool in response to that. I think it certainly put pressures pretty significantly on the exchanges to respond to that price, and I think you do see some compression of their capture on a per contract basis. But I think there was a balance struck, and the debate is taking place in the equity markets right now on price. So you do have a lot of the high price names that continue to trade. We're in a nickel environment where maybe that's more appropriate in terms of providing liquidity as well as in higher strike prices above $3. So I think there's been somewhat of a middle ground struck.
I think obviously this penny pricing has not all been good for the market makers. I think the benefit to the customers is somewhat exaggerated. You're only talking about a couple of cents more, and the typical customer probably shouldn't be so terribly concerned about it.
A couple of cents? I mean, what do you charge them in commission?
What? Well,
a fraction of that? I mean, a couple of cents is monstrous.
Well, I mean, look, I don't want to totally sweep it under the rug. On the other hand, if we're talking about real innovation, whether we should have a nickel spread or a penny spread, doesn't seem to me that it's just still scribbling in the margin. I mean, it's not the real opportunity that is in front of us now.
I heard transparency, price, a sense of fairness, that it's not a rigged game. I'm wondering what other values might usefully drive innovation in the category. What else ought we be aiming for?
Well, when I think about innovation, I think about new products, whole new things, derivative products that are not options, great opportunities. And, I think it's just silly that we're talking about, as I said, I think pricing is very, there have been some very, clever, smart ways of concealing what you're actually charging, but it's not innovation in the traditional sense of the word.
No, I would say, though, each one of these changes does create opportunity. And we can all sit here and complain about pricing or penny pilot or whatever the heck it is, but they've all created new opportunities. Fragmentation in and of itself creates opportunities for firms like us. We now have 9 options algos. We push out an offer because people need help sourcing liquidity now. They don't just send it to the SIBO or they don't just send it to the ICE. They need help. So we've built products to help address some of these challenges. Complaining up here all day long is not going to really help us. Look forward, and we'll be able to figure this thing out. But we're still in the early stages of pricing, early stages of market structure. This thing hasn't settled down. 2010 is going to continue to be a shakeout year, and we're going to see it will get worse before it's going to get better in terms of pricing. So accept it and figure out how to deal with it.
You're talking to the wrong guy when you're talking about accepting.
We'll have to have you removed from the room if you
I would just add, with respect to real innovation or new products, we've always focused on adding derivatives onto securities products. And there's a lot of asset classes out there that we haven't touched. There's an enormous fixed income world that we should be looking to add derivatives products on that. A lot of that stuff is still pit traded, it's floor traded. It's incredibly wide, it's incredibly expensive, it's incredibly difficult to access those markets. If we bring that into the 20th century, that could be a huge product set for us.
And I'd just make one other comment. I think certainly stripping away some of the proprietary index products, I don't think there's no marketplace in the world with the kind of liquidity and both retail and institutional participation that we have here in the U.S. options markets on equity option products. And so I think a lot of that has been driven by the fact that we've gotten the market structure right. And so I think that's something we need to be mindful of, particularly as we engage in a very kind of detailed, vigorous market structure debate, and we tend to try to focus on what's broken. If you just look at volumes, you look at participation in the marketplace, it's never been better. So I think that's one place it does work. There's a very transparent and fair marketplace that incents a lot of different participants to come in and engage in the options markets, and that's important to keep sight of.
Rich, you pointed out that there may or may not be enough exchange executives in the audience to defend themselves, so I'm going to represent the exchanges for a moment. For many years at this conference, we used to have an upstairs-downstairs panel where the OTC market makers would debate with the floor market makers. I think next year we should have the exchange leaders against the planned innovators panel.
I'll clap for that.
I'm gonna speak for my peers and tell you that I could not be more proud of the innovation at each of the exchanges. And that's from a technology perspective, a marketing and education perspective, new product development, the front end and back end services that we all provide. And I would say that we are not the ones that are driving innovative or innovation in pricing. That's being driven by our customers, who are moving market share around and moving order flow around properly to respond to the pricing that they are driving. I want to give one example of a product that you referenced, and that's to bring in the order flow from overseas into the United States. We are the poster child of an example where a European exchange buys the ISE, and for over 3.5 years, we have been trying to get approval to allow firms from overseas to send an order to our limit order book. And we are not able to get that approval from our regulators. So I would love to debate this with you individually, and I'm looking forward to visiting you and finding out about the new product opportunities that we have. But I have to say that the broad brush approach that's been taken here against the exchanges and their desire to innovate is a little strong. And we look forward to growing the business with you.
That very eloquent voice was Gary Katz, if you don't know him, CEO of the ISE. Was there another question? Okay. I think there's a fair amount of debate on, when you look at, I think it's very fair, Sam, when you, just the scope of what you see as innovation, whether you see sweeping changes, whether you're looking at innovation as a sweeping change, which, Sam makes some fantastic points, as well as innovation, that's a stepwise to get to a bigger goal as well. So I appreciate everybody in the audience participating here early on a Saturday, and I know everyone up here would welcome to debate this more if there's any strong feelings in the audience. Thank you, and thank you, panelists, for participating.
And that's going to do it for this episode of Options Insider Radio. Be sure to visit www.theoptionsinsider.com for more episodes of this program, as well as breaking news from the options market, the latest articles and analysis from options experts, a wide variety of options education, and of course our discussion center where you can share your questions, comments, and insights with your fellow Options Insider users. While you're there, be sure to register for our monthly email newsletter, as well as our free email alert system. Our email alert system makes it even easier to stay up to date on the latest content from theoptionsinsider.com. Thanks again for listening. My name is Mark Longo, and I'll see you next time on Options Insider Radio.
Options Insider Radio was created by Mark Longo and produced by Gene Crotty. Options Insider Radio is a production of the Options Insider Incorporated, all rights reserved.